Hello, everyone. Welcome to another episode of Personal Finance. In today's episode, we're going to look at how you can reduce your income tax liability. Let's go ahead and get started. As I mentioned on the episode one, the federal income tax is based on marginal tax rates as your income goes up. As an example on this slide here, for the first income tax bracket is around 10% and it's up to 23,850 for married filing jointly. And let's say if you have an income higher than that, from 23,850 to 96,950, then this particular amount will be taxed at 12%. And it goes up, and then the next bracket 22%, and then all the way up to 37%. So the amount between one tax bracket and the next tax bracket is where that particular percentage will be taxed. So it's not like the entire amount gets taxed at the higher tax bracket. As an example, if you had $150,000, then you will be taxed between these three tax brackets: 10%, 12%, and 22%. So only the amount that is higher than 96,950 will get taxed at 22%, so that you have a little bit relief on the overall tax liability. So let's go ahead and look at two scenarios how you can save on taxes, right? The first one here is married filing jointly, and the assumption here is the yearly income is $150,000 and they are taking the standard deduction while filing the taxes. There are two options. One is called standard deduction, the other one is called itemized deduction. And we will look at the differences in a later video. But in today's discussion, we're going to assume they are using the standard deduction. So 30,000 is the 2025 standard deduction. And if you reduce 30,000 from your salary, total salary, 120,000 is the amount that will get taxed. And based on the tax brackets, you can see the first 23,850 will be taxed at 10%, and then 12%, and 22%. If you add all of them, your tax liability is $16,228. The assumption here is they did not contribute anything towards retirement account or any other account that might save on the taxes, right? So the first scenario, no tax optimization. The second one here, let's assume they take advantage of the retirement account and also HSA, right? 401k is the standard retirement account most of the employees have, and there are a few other variations based on if you're a government employee or if you're working as a teacher, and we will look at a separate video on different types of retirement account. The second one is HSA, right? High or health savings account. This has triple tax advantages, and I will do a separate video on HSA because it's very important that you explore this option if you are not doing that today. You need to be on a high deductible health plan to be able to use HSA. So let's assume in the second scenario, same 150,000 income, and they have the standard deduction 30,000. They're not doing an itemized deduction. For 2025, the 401k max contribution is 23,500, and we are assuming the employee is less than 50 years old. Above 50, there's an additional contributions you can do, and for today's discussion, we'll keep it simple. And 8,550 is for a family for an HSA, that's the maximum contribution limit. So if you add all of these and deduct from your total income, so your taxable income becomes 87,950, and it can see compared to the previous scenario, there's a significant drop on your taxable income. And then if you get taxed for 87,950, you get 10% for the initial amount and then the 12% for the difference. You dropped actually one tax bracket compared to the previous one, right? If you're 150,000 or 20,000, you had the third tax bracket as well. And if you look at the second scenario, the total tax liability is $10,000.76, and the difference you saved is $6,151, right? And this savings every year you can contribute towards other investments or use it towards other expenses, right? Ideally, you want to use it for other investments so it can grow as well. There are other options available for you to be able to save on taxes. I'll quickly go through them. It might be applicable based on your individual scenarios. The first one is flexible spending or limited purpose FSA, right? If you have a HSA plan, then you are allowed to do only limited purpose FSA. In terms of what you can claim, there are differences between these two accounts. You can quickly Google to find what's allowed. Key thing I want to highlight here is if you have kids, look at your last year's expenses in terms of glasswares like eyeglasses or contact lenses. Those are very common, which you can get reimbursed and use your pre-tax dollars. The other big ticket item is the braces, right? For your kids, if they are around the teenage year, that's when you would go to your dentist and then look at whether they need braces or not. Typically, out-of-pocket expense is around $5,000. So if you know that expense is coming next year, then you plan for it and contribute towards your FSA or limited purpose FSA as much as possible and use that pre-tax dollars for that expense. The other one is dependent care. If you have kids on daycare, you can use that as well. The only caveat here is it does not get carried over in terms of if you have any balances. In terms of FSA or limited purpose FSA, there is certain amount, I believe 660s for this year, that will get carried over. If you have more than that, then you lose that money. The third one is commuter benefits. Not many companies offer that, but I did find out few of them offer, and it's based on whether you're taking train or if you have parking expenses, you could use pre-tax dollars, right? You get deducted from your paycheck as a pre-tax amount, and you would get reimbursed for those amounts. The other one is traditional IRA. Again, not many people might qualify based on the income. It does get phased out, the tax benefits that you get for the traditional IRA. And there is a link in description that has details on what is the income range where it get phased out. Again, you do have income tax deductions, but it's not everybody might be eligible. And then the 529 plans, again, if your state is offering state tax deduction, that is another option. Not many states offer. Illinois, as an example, does offer that, so take a look. Rental properties is another one. Again, it all depends on whether you have rental properties, you have income coming out of rental properties. There is also income limits. The key thing here is rental property, you can do something called depreciation. That can be used towards the tax benefits only if you are on certain income, right? The other option is if you have a spouse who is a real estate agent, then you have a lot more benefits to do that. So something for you to explore. And if you're doing itemized deduction, then you might be able to deduct home mortgage, state and local taxes, real estate tax, your property taxes, charitable contributions, or donor advice funds. Right? Again, you have to itemize for this as well. Charitable contribution is something you would contribute towards the charity like Red Cross or any other charity, right? You get 25% back um, from your contributions. Let's say you have a big bonus or you sold a lot of stocks and you have a lot more money and you want to have some tax benefits coming out of that. Something called donor advice funds is available for you. The difference here is you contribute, let's say, 10,000 towards the donor advice fund. Schwab and Fidelity and few others offer, and that particular year you're contributing, right? The 10,000 will be counted towards your charitable contributions. But the fund that you gave to Schwab or Fidelity can stay there and grow over a period of time, and then you can start giving that money to charities at a later date, right? So you get the tax benefit the year you contribute, but the money is still there for you to be able to distribute to any charities at a later stage. If you do have a business, then you have a lot more options. I'm not going into details, but business is one other best way to get a lot more tax savings. Typically, if you have an LLC, then it would flow through your personal tax returns. So that's something to explore as well. So these are some of the common ones. If you do have other suggestions, please post it on the comments or drop an email to see what might be available for people to take advantage of. So this is the contribution limits for the 2025. You can see that last year and this year's, and I have a link in the description that takes you to the page that has this slide and goes over the income limits as well. So you can go ahead and take a look at that. Hopefully this video has been helpful. The key thing is to look at the options available to you, how you can legally minimize your tax liability, right? When you are a W-2 employee, you don't have a lot of options, but there are a few options that you can take advantage of. But if you are a 1099 employee or you have business, then you have a lot more options to claim as business expenses. But W-2 employees do have certain options that I went through. And if you have any feedback, I'm looking forward to hearing from you. And hopefully this video has been helpful. Thank you.